Priya, let's get straight to it. This bond market sell-off, are these moves a substitute for further action from this Federal Reserve?
They absolutely are, but I think if you look at the recent data, we're not really seeing that in the data. So what the Fed, I think, is trying to do is buy time. I think they want to look for the data. I mean, the recession playbook is not working out. There's been significant rise in real rates. I mean, the entire COVID savings buffer seems to be largely gone, and yet the consumer continues to power away. So, I would argue that the setup for a recession is there, but how long does that take? Is that 6 months? Is that a year? Is that 2 months? I think we don't know. The market doesn't know that. The market's pricing the recession date, I think, much further out. But the Fed doesn't know either. And I think it's notable, the shift from the Fed over the last week. I think, Chair Powell's likely to emphasize that the market's done some work for the Fed. But are we restrictive enough? I think they don't know this. And which is why I think he's not going to take another hike off the table. But I think the urgency for the Fed to continue to hike, inflation is coming down. I think that urgency is just much less. So I think they're going to buy time, wait for December. If the data continues to power through, I think early next year we might be looking for more hikes. Why just stop at 125 basis point? But I think it's just too early for the Fed. So I expect another message of let's be cautious. We need to proceed carefully. There's been a very big tightening, at least on the real rate side. I think they're waiting to see whether that filters through across overall financial conditions.
Big move in this bond market, though, over the last few months. Let's go through it together. 2-year, 5-year, 10-year, 30-year, all in the last 24 hours, looking at new cycle highs. The 10-year at the moment up a couple of basis points to 493. Almost at 5% over the last few hours. Jean Boivin, this is the question that Andrew Hollenhorst over at Citi is asking. How will this Fed weigh the recent data relative to this bond market sell-off?
Yeah, I think they're focused on the bond market sell-off, and I agree with a lot of what my colleague just said. But I think, I don't think they know themselves what to make of this long-term rates backup. And I think as a result, we're going to be in a few months where we're going to see signals going in all directions. That's why we've now expect high volatility, two-way moves on 10-year. We've been underweight U.S. Treasuries on the long end for the last 3 years, and this week I've started to turn neutral. Not because we think rates will go higher over time, but I think now we're in a world where the Fed itself doesn't know what it's doing, so it doesn't know what to make of it. And so you've seen that through the speakers. I don't know what Chair Powell will say exactly, but I think they're concerned about the long end getting out of control, and that's going to dominate over, in my mind, the recent data.
Yeah, just to echo that, I think it's important. We heard that from Neil Kashkari of the Minneapolis Federal Reserve. Priya, he was perplexed by the moves. Do you think they've got a decent understanding of what's driving all of this?
They look at bond market models and they argue it's term premium. If you look at why has term premium increased? Now, there has been a little bit more supply, but it's the buyers that have stepped away. And why have the buyers stepped away? Because we've heard from the Fed loud and clear, higher for longer. We've heard a Fed that's data dependent. Data inherently is lagging. The Fed is not really looking at forward-looking indicators. So I think the buyers, and we were buying early on in the move. And then once we broke those technical levels, we took a step back and said, we're going to need to wait to see where it settles down. I think we're nearing the peak. Very hard to call the peak. But I think, back to your question on what drove the move, I think it was, to a large extent, the buyers getting nervous. It's paid to wait all year. If you're sitting out in cash, you're earning, 5.5%, 6%. And so why extend out the curve? The data has not supported it. Fed speak actually pushed back against it in September. I think the Fed is trying to undo some of that damage, but they haven't fully gotten there. I don't think the Fed understands how hawkish that September Fed meeting was, which I think took all the buyers and put them on the sidelines, and everyone decided we just wait and hang out in cash.